and welcome to the CFO Weekly Newsletter. Thank you for joining me. Well, right now in the markets, I am actually going to be preparing myself and my members for when this market has a decent size correction, right? May not be a crash, but I think we're going to see a decent move to the downside, at least a correction, which is 10%. Obviously a crash would be 20% or more, and I'm looking for that very soon. Let me give you my rationale behind this logic. If we look at the SPX, we can see that, since the March lows, we have been moving higher, right? And it's still very close to all-time highs when we look at the SPX, which is the best gauge of the US stock market. However, I believe that this move higher is just an illusion. And let me give you my reasons for that. First thing I'm looking at is high yield bonds. Now, high yield bonds are a forerunner for the stock market. When I look at the 21st of the 5th expiry in the option chains, I can see here, when I look at the put options here, I can see large amount of contracts here in the open interest. The amount of contracts that are open at these specific strike prices here. You can see here 121,000 at the 80 strike, 172,000, 80,000, 70,000, 229,000, 157,000, 91,000. If we look on the call side, there's little to nothing. So what this is showing me is that some of the most well-informed, sophisticated investors in the world that invest in the bond market are placing an incredibly large trade, incredibly large bet that bonds are likely to move down. As a result, the market would move down. If I look at the 10-day moving average of the combined put-call ratio, anything between 0.75 and 0.79 is bearish. It shows excessive call buying. It shows that everyone's comfortably long, comfortably bullish, and this is an insanity point. There's no one left to buy. Markets are likely to roll over. So 0.79, it's showing me that with that one data point. If I look at the skew, which is the perceived risk of a 2 standard deviation move or more to the downside, in other words, a market crash. If the smart money is worried about a market crash, the skew, which is a market internal, will be above 135. Right now it's at 143.7. So this is very bearish right now. Smart money's worried about a crash, you should be too. The SPX put call ratio, when that is below 1.75, again it shows excessive call buying. Look for a top in the market. So this is very bearish right now. Now, when we look at the momentum in the market, one of the things we can do is we can have a look at the year to date, the number of stocks that are making new highs and the number of stocks that are making new lows. You can certainly see the amount of stocks making new lows is far higher than the amount of stocks making new highs. So that's one thing. The other thing that I look at is the amount of stocks, percentage of stocks that are above their 50-day moving average. Just a month ago, there was around 78% of stocks that were above their 50-day moving average. Right now, as of last night's trading, it's now 48%. So when this gets below 50, that's another warning sign. Okay, so that's another warning sign that this market could move down. Another thing that you look at here is you have a look at the number of stocks that were down by 6% last night, 859. You look at the number of stocks that were up just 1%, not 6, just 1%. If you have a look at that, you can see that was only 824. So there were more stocks down by 6% last night than there were stocks up by 1%. Well, how many stocks were down by 1% then, Sean? Let's have a look. $3,529. So while the SPX is moving higher and close to all-time highs, it's an illusion. It is a market of individual stocks, not a stock market. And the individual stocks that make up this market are not all bullish. That is for sure. There is momentum signs that the market is bearish, wants to turn down. There are market internals that are showing me that the market wants to turn down. And I am going to pay attention to that. Sean, could you be wrong? Of course I could be wrong, right? I'm not so arrogant to believe that I know everything, but when I see all of these things lining up like this, like I did in late February when I helped my members make incredible amounts of money with put options as the market fell 35%, I will take action. So for me right now, I'm exiting long positions, right? Call option positions, call spreads, anything that's bullish. And what I'm doing is I'm actually positioning myself with bearish setups and trades right now. Okay, we've already. The other thing I'll look at as well, if we look at the VIX. In fact, I'll look at this chart here in the VIX. So if we look over here, just give me a second. So if we look at the VIX here, so right now you can see that, since the pandemic, since the sell-off at the end of February last year, we obviously saw a huge spike in volatility. But ever since then, it's remained above 20. Very stubborn, remaining above 20. And, obviously before that, it was consistently below 20. So the fact now that it's stubbornly staying above 20, and recently it's now moved back down to that 20 level. My members are in VIX calls right now out till June. Okay, last night went up almost 4.5%. And when it's down here, what does that mean? It means that the market's free to sell off. It means we could see a spike in volatility. At least leaves the door open for that. So that's another warning sign as well. When I look at my SPX opening range, okay, when I look at the first trading day of the month and the third Friday of the month, which happens to be right here, the third Friday, I take the high and the low, and if it gets above that high, then we're in bullish mode. If it goes below, we're in bearish mode. Now, right now we're sitting right on the lower range here. We're almost in bearish mode, but we're not. So that's the only thing there that isn't quite lining up. But when I look at all these major indexes here, let's look at them from an intraday point of view. So 5-minute chart, for example, we can see strong sell-off into the close. Okay, strong sell-off into the close. We look at the Russell 2000. We'll talk more about that in a moment. A strong sell-off into the close. Amateurs open the market. Professionals close the market. So this is pretty significant. NASDAQ selling off strongly into the close. See these candlesticks closing on or near their low. In this case, on their low. So strong selling into the close. We look at the transports. All of these indexes are doing the same thing, selling off into the close on yesterday's session. Okay, and here's another one here with Dow Jones Industrials. There it is there. Again, selling off into the close. So there's certainly some bearishness there. If we look at high yield bonds, they were selling off into the close as well. And what I've been looking at is this. Where is it? Right here. This trend line here, this level of support. You can see here, here, and here. It broke it temporarily, then moved up above it. But this, while it's a green candle, is not bullish at all. And we just showed you that it actually sold off into the close. So the buyers tried to take it up and the sellers took it all the way back down to close here. So this is a very weak buying pressure here. So there's quite a few signals there that have got me concerned about whether this market's going to continue to move up. Now, not concerned about my account, right? We've made a lot of money recently, just this year, on some very great bullish trades to the upside, right? It's been fantastic. However, I'm changing my approach right now, and I don't really mind whether it goes up or down. As an options trader, I couldn't care less. But right now, I'm positioning myself for the downside right now. Okay, so what are some of the ways you could do that, Sean? I understand what you're saying, but what are some of the, well, you could just simply go out and buy put options in the SPY, right? That's one way to do it. For me personally, I'm taking them out to June. Okay, the June contract. You could obviously buy put options in the Russell 2000. Now, interesting with Russell 2000, it's had its second day closing below the 50-day moving average. So, quite big wide range body candles here as well. So that's very interesting. You could buy puts there, obviously. The QQQ, you could buy puts there, relatively inexpensive. Okay, that's been using the 50 as a resistance level. There are more aggressive ways of doing it, but the problem with these more aggressive ways with inverse ETFs is that they can actually hurt you when they move against you. So if the market was to have a strong move up, an inverse ETF, which moves opposite to the market, would lose money pretty quickly. However, if the market does sell off, these inverse ETFs will make you a lot of money very quickly. So, it's a double-edged sword, really. One of those could be SDS. Okay, you can see as the SPY or SPX goes up, the STX goes down. Another way you could do it is SH. Again, these are more aggressive, not for everyone. They are certainly more aggressive. If you wanted to look at something on the Russell 2000, you look at that there, you can see TZA, again 3 times leverage ETF. So this will move up very strongly. You can see last night the Russell 2000 was down 2.3% and the TZA 3 times leveraged ETF was up 6.88%. So moving up roughly 3 times as much. So this will move up very quickly if the Russell 2000 does start to break down, and it will make you a lot of money, but it can also work the other way as well. So for me, VIX call options, I've got just looking to buy put options on several of the indexes and maybe on just a very small portion of my account some of these leveraged ETFs. So that's what I'm seeing in the market right now. We are certainly positioning ourselves that way. But the other thing you could do as well, if we were to see a large move down in the market, is you could just simply sit in cash and wait for things to sell off. Because you've got to understand that if the markets do sell off, once they've sold off, there's amazing opportunities to make money to the upside. Think about this. Let's say there was a fantastic stock that was $100. The market crashes or has a big move down, and the stock drops from 100 down to 20. Now, obviously, that's an 80% fall. That's a big fall. But think about this. What about after the crash is finished and everything's at very cheap prices? What about if the stock then goes from $20 back up to 100? That's a 500% gain. On the way down, 80%. On the way up, 500%. So the ability to make substantial money on the way up after things have sold off is very, very real, and it's a fantastic way of doing it. So you've got 2 choices here. Get into cash, wait for things to sell off, then start buying up, or you simply set up positions like I'm doing to make money as things move to the downside, and then looking to make money on the way up as well. That's what I prefer to do. But there's a couple of different choices there right now. But for those reasons that I've explained, I am a little bit, quite a bit bearish on the market right now, and I really want to set myself up to make a lot of money if the markets do fall, or at least to hedge and protect some of the positions that I have. I've closed out of all of my bullish positions for now, because again, you can always get back in. People always forget that. You can always get back in if the market does move up. But for me right now, very cautious, and I'm setting myself up on the downside, and I hope you guys found that useful. All I can do is try and help you out as much as I can. If you like this content, you like me doing special reports like this when I see things in the market, please let me know and send an email to support@cashflowoptions, all one word, cashflowoptions with an s.com.au. Let me know what you think about this special report, and if you'd like me to continue to do things like this. So thank you very much for listening. I hope you enjoyed that. Stay safe, have a great rest of the week and a great weekend, and I'll talk to you again next week. My name's Allison. All the best, and bye for now.